But apparently, the average UK citizen will pay £825,000 in tax during their lifetime. Hey guys, welcome back to another video. How you doing? So, ever since I started this channel, we talk about investing here, obviously. So I get a lot of questions, and one of the big questions that I get that I think people are confused about and want to know is, well, what tax do you pay on your investments? And I haven't got around to it until now. So this video is going to talk about tax on investments, how you can get away with paying a zero. But on a serious note, though, there are some changes on the horizon. They were signaled last year. We don't know how big these changes are going to be because we actually have one of the most generous tax allowance regimes globally. It's really important we cover this and highlight a few things for you. So I'm going to provide a lot of context. If you don't want to stay for the context stuff that's going to make everything else make sense, then use the timestamps to skip forward. But if you're new to this channel, welcome. This is where we talk about money, finances, where we give you information, education to help you make the best financial and investment decisions possible. If you haven't subscribed already, make sure you subscribe. The channel is growing. I'm thankful for it. Make sure you hit that like button as well, because it's going to help with the YouTube algorithm. It means that someone just like you who is looking for this kind of information and needs this kind of information can find this video and get benefit from it. And make sure you hit that notification bell. Upload every Tuesday and every Friday at 5 p.m. All right, so in preparation for this video, I did a little bit of research on taxes and tax rates and where we sit in the scheme of things with Europe and everything, right? And I came across a statistic that absolutely blew my mind. And when I thought about it a little bit more, it actually does make sense. And this is the stat. And tell me whether this blows your mind or not in the comments. But apparently, the average UK citizen will pay £825,000 in tax during their lifetime. It's £825,000. That is a big number. And in all seriousness, we know what taxes go towards. Taxes are the reason why we can have, the police, the fire service, the NHS. Don't we need the NHS right now? It's the reason why we pay taxes, and that's what the money basically goes towards, amongst other things. But one thing we do know is that because of COVID, because of everything that happened last year, and we're still kind of in it in 2021, the first starts of 2021, we know that the cost of COVID is quite high for the government. If rumor were to believe, we actually have a national debt now that exceeds £2 trillion. £2 trillion. This money has to be paid back in some way. Furlough has to be repaid in some way because that's money that has been provided via debt. The CBIL scheme, which was to support businesses, that has to be paid back in some way, shape or form. And Rishi Sunak has signposted that there are likely going to be changes in the future, possibly this new tax year that will arrive later on. And the reality is that some of the things that he's looking at will be things like capital gains tax, where either the threshold is going to be reduced or we'll see a combination of the threshold being reduced and the actual rates of capital gains tax being more in line with your income tax rate. So if you're a basic rate taxpayer or higher rate taxpayer or an additional rate taxpayer, we're likely going to see, reportedly, capital gains tax rates move in line with those things. And we might also see, again, like I said, a reduction in the capital gains allowance as well. And look, I can understand why that is the case. It is estimated that changes to the capital gains tax legislation as it currently sits will raise an additional £14 billion. Now, £14 billion does sound like a lot of money, but we've just realized that our national debt is 2 trillion. So 14 billion is actually a drop in the ocean when we look at it against the bigger picture of where we essentially are. So if we're going to repay some of the debt that we have, and we haven't even talked about GDP, by the way, and our debt ratio to GDP, that is astronomical. Changes are going to have to be made. So on your investments, if you are investing, what are the tax allowances as they currently sit that you can take advantage of, and how do you pay zero based on what we know right now? Again, you may be watching this when the legislation has already come in, and maybe some of these allowances have been reduced, the tax brackets have changed. But as of January 2021, what are the taxes on your investment? What allowances do you have? What are things that you need to bear in mind? Let's get into that. Okay, so the first tax that you are going to pay on your investments, particularly if you're using the likes of Trading 212, eToro, Hargreaves Lansdown, or anywhere that you're buying shares electronically, is your stamp duty reserve tax, and that is charged at 0.5%. It is something that you can't actually get around. You can't mitigate this one, but it is automatically included in the transaction cost when you're purchasing your shares. So you're paying tax. Just figure it as though it's VAT that is already included in a product price, right? So you're buying stuff down the shop, you're paying 20% VAT on top of that automatically. It's kind of exactly the same thing. The cost is included in the service cost when you purchase these shares electronically. If you're not purchasing shares electronically, then it is reserved and only payable if you are buying shares at over £1,000 in value. But for most of us who are using for Trading 212, Free Trade, Stake, and some of the other apps that are out there right now, you are going to be paying it as part of the process. And unfortunately, you cannot mitigate it. So capital gains tax can be quite confusing, but let me just try and break this down in simple language and just use an example so that you can easily understand what this is all about. So capital gains tax is basically a tax that you pay on basically gains that you have from invested capital. So, for example, if you go and buy one share of Tesla, I'm going to use Tesla as an example here because, you know, I love Tesla, and many of you guys watching me know that I do. So a share of Tesla at $850, for example, let's just say you double your money, so the share price goes to 1700, right? So you've got a 100% gain on your initial investment at 850. The difference between where you went in and where you sell is essentially your capital gain, and you will pay tax on the difference. So your capital gains tax is literally when you purchase a share and you sell it for a profit, you have to then pay a capital gains tax on the profit that you make. Now, there are allowances at this current time. So again, this is going to be correct as of January 2021. You currently have a capital gains tax allowance of £12,300. Now, this is the tax allowance that had specifically been highlighted last year by Rishi Sunak as one that he will potentially look to reduce, or at least bring the rates, which we'll talk about, in line with income tax rates. Now, really, really important to note that if you are buying shares on Trading 212, on Free Trade, places like that, or eToro or Hargreaves Lansdown, it is your responsibility to make sure that you're keeping track of what you're buying and what you're selling and at what profit you're actually making on these trades or on these sales when you actually do that. Now, there is no capital gains to pay if you're simply just selling something, then reinvesting that money. You only pay capital gains tax if you were to sell a position, so sell your Tesla stock and actually receive the money into your bank account. You need to keep track of that, because if you go beyond your 12,300 limit, then you're going to pay capital gains tax on the difference. So bear that in mind. Few tips. Let me just summarize very, very quickly. You have a £12,300 allowance. If you go over or sell your assets or shares for a profit over and beyond that 12,300 limit, you are going to pay tax on the difference at your rate, according to whether you are a basic rate taxpayer, which is 10%, or a 20% rate if you're a higher rate or additional rate taxpayer. But again, you don't have to pay capital gains tax if you are selling assets and simply just reinvesting the money. It is due once you cash in the money, you receive the money to your account. As always, make sure that you keep track of how you sell these things. If you're literally selling assets, receiving money on a regular basis, you need to be noting all of that down. make sure you don't fall foul. Make sure you keep track, because it's your responsibility to do a self-assessment to HMRC on a yearly basis. So dividend tax. Now, we talk about dividends quite a bit, right? There's so many videos here on YouTube talking about dividend stocks, dividend payments, so on and so forth. You have to pay tax on dividends. Now, the dividend allowance used to be very, very attractive. It's not so attractive now. It's only £2,000 on your investments for your dividend allowance. You can receive £2,000 in dividends without paying any tax. Anything over and above £2,000, you have to pay tax at the rate that I'm going to mention in a moment. So again, just like when you're looking at monitoring your capital gains, it's really, really important for you to start to take note of what dividend payments you are receiving. And you have to keep track of this. You have to report this to HMRC when the time comes to do your yearly assessment. And again, if you're holding quite a bit within your accounts, then you really should be looking at enlisting the help of an accountant to help you do this. Self-assessments can be very, very easy, but you need to spend the time to actually do it. So if you haven't got the time, go and speak to an accountant, get an accountant to do that for you, but they are very, very simple to actually complete online. But your dividend allowance is £2,000, not a lot of money. So if you've got quite a bit invested, you're looking to generate dividend income, then you need to be aware that you are going to be paying dividend tax as well. And the rates for dividend tax are as follows. If you're a basic rate taxpayer, you're going to be paying 7.5% of any dividend payments that you actually receive. If you're a high rate taxpayer, then it's 32.5%. And if you're additional rate taxpayer, then it's 38.1%. Please bear that in mind. So again, making sure that you're actually tracking what you're doing and what you're receiving in terms of dividend payments. Now, I have spoken about doing your self-assessment. Self-assessments are relatively easy to do. You literally just log on to HMRC. I would encourage anybody to literally just pick up the phone to HMRC if you have questions on this kind of stuff. In the past, I have done self-assessments myself, and if I've got stuck online trying to file my self-assessment, the guys at HMRC are very, very good. They can talk you through the process. I know that they've certainly done that for me on a couple of occasions in years gone by. So please bear that in mind. So in all seriousness, guys, I talk a lot about ISAs here on this channel, and I feel like I'm a broken record when I say tax efficiency first. But that really is the rule. Tax efficiency first. And if you remember anything from this video, please remember that and let that be your mantra. Tax efficiency first. Say it with me. Tax efficiency first. Because quite literally, with your ISA allowances, if you don't use it, you will lose it. And the last thing you want is to look back over your investments and think, I wish that I'd used my ISA allowances. We might be in a situation where, in the future, the ISA allowance gets reduced. And look, if you look back over the charts, the ISA allowance has increased quite significantly from where it began and where it was even, 15 years ago. So we have to appreciate what we have right now, and we have to make the best use of it. And if you gain anything from this, please take that away. It is literally the only way that you can invest money into the markets, start to generate wealth, and pay zero tax legally. But guys, let me know what you think in the comments. If you have questions, please let me know. I am not an accountant. If you are investing with serious amounts of money and you've got, good pots or portfolios accumulated in general investment accounts, you're using up all of your ISAs, then really, from a tax planning point of view, you need a proper financial advisor. In terms of reporting and managing your tax, paying your tax, then you also need an accountant. I am not an accountant, so I can't answer tax questions specifically. But do let me know if you have any high-level questions in the comments. I will answer the ones that I can. The ones that I can't, I will say that I can't. But guys, I hope you've enjoyed it. If you haven't listened to the podcast this week, there it is right there. Enjoy your weekend, but always remember, money is a tool, life is for living. Catch you soon.